Uh, Hello, everybody. Uh, Before starting, please let me know if everything is okay. You can hear me well, and because this is going to be a very important session. So, if you can hear me well, and you can also view my presentation. So, please let me know if things are well, okay. So, there are a number of participants, and they are growing. So, please let me know if things are okay. Please let me know if things. Uh, so please let me know if when will the class start. Yes, I have started. Gurpreet sir, you will cover all topics. No. It cannot like it is not like that, my dear Gurpreet. We cannot do that. Good morning, sir. You will cover syllabus of. Is this is am I? You can hear me. Am I audible? Perfectly audible. So am I perfectly audible? Because the class has started. Am I perfectly audible? Am I audible? Yes, and you can see my presentation. Am I audible? And you can see my presentations. Okay. I didn't check out with it. Thank you very much. Thank you very much. Okay, let me start with the situation. So there are people who have done my classes and who have not been, who is the first time over here. So first point is that the only way I can share the documents, well, of course, through the institute as well, but if you join this classroom, you will get the documents immediately after the class is over. So this is the link of the classroom. So I will again give you the link in the box as well. So you can join this link and get to the classroom. So first of all, let me go back and this is the classroom link. So this will help you to immediately get the notes after the class is over. Well, this is the topic, and if you those students who were there in the previous room of mine 1 hour session I had, so we did a little bit of introduction. So I understand that these classes of mine are falling as and when the institute is asking me to talk. But naturally, I have a sequence to go on. So this is a sequence. I talked about the introduction to capital management, financial management, and in the same day, I talked about cost of capital. So these are the two things I talked on the first day, which maybe in March or April, I don't remember well. So and today, I would like to talk about capital structure theories. So this is my topic, and this is a nicely drawn out document which you can have, which I prepared specially for this classroom. And it has some it is you can just the pages. It's a 21-page document. So there are 4 theories, the issues, and the importance of capital structure. Of course, these are not mine. So I have given you a disclaimer about the content. So these are not mine. It is only my perspectives that I have added to the classroom for the classroom. So this is a syllabus which you have 50 marks and 50 marks of financial management. And this other 50 marks, actually, I'm taking classes on paper 8 as well. Some of the talks I'm having. So naturally, this would be better if the introductory issues of paper 8 is dealt with. So that is why I have highlighted. I'm highlighting these issues, initial issues on financial management. So this is what we talked about: the introduction to financial management, and of course the cost of capital. Naturally, the automatic consequence of the understanding is we talk about capital structure. Of course, you would have discussions. You would like to have that. You like to understand that. But that would be doubt clearing sessions, and you can ping me, you can mail the institute, and I will of course come along and with doubt clearing sessions. But what we did basically now, basically, so our issue is financial management, and that is your 50 marks. And so what we did basically, it is we basically it is all in the balance sheet. I have intentionally kept one topic, which one slide which was there in the previous day as well, today also. So I'll check out. You can check out. So basically speaking, where we are, what we did, just 5 minutes of recapitulation because there are some new students, and then we jump on to today's topic. Now, the point is that these are you raise money from these issues. These are the sources of finance. So these are sources of finance. And so when we talk about raising money, you raise money, and naturally you then spend your money. You cannot just sit with your money idle. So if this is the money, if A is the amount drawn, or maybe 100 rupees is the amount you have raised, you must invest. You must invest that 100 rupees. So you're basically speaking, the balance sheet says that the sources of finance is also the application of finance. So the sources of finance is equal to the application of finance. So that is the basic issue of our financial management. Now, this application, when you apply this money, you apply it in long-term sources, for long-term perspectives, and in short-term perspectives. And of course, when we're talking about short-term perspectives, you also have short-term finance. Now, when we raise this money, we have to pay some portion to outsiders. For example, you raise debt, you have to pay cost of debt. You have to pay them some amount. For example, you have raised 800 rupees, you have to pay 7 rupees. That means your cost of debt is 7%. You raise equity, and naturally you have to pay cost of equity. You raise preferences, and you have to pay cost of preferences, KP. So KD, KE, KP, and of course KR, that is cost of retained earning. Cost of retained earning. So this was basically the previous day. So we naturally, whenever we talk of raising money, when we talk of raising money, we have to first of all talk about cost of capital. So the first of all, you have to consider the issue of cost of capital. So it is of course my perspective. In books you will find differently designed issues, but I always feel that this is the first topic you must understand in your financial management, because unless and until you raise money and you pay them some issues, you cannot start your business. So first of all, you need to pay money. So maybe every day when I start my sessions, as and when I am asked to do so by the institute, I will be talking on this perspective. So I have to talk on this perspective every day before I start. So maybe for 3 minutes or 4 minutes or 5 minutes, I have to talk about this. So this is the basic understanding of your cost of your financial management. And so you have, basically speaking, you have your cost of equity, cost of debt, cost of preferences, and cost of retained earning. And of course, the average is called the cost of capital. So this is also what you call WACC, weighted average cost of capital. So this is the first class we had. So we talked how to calculate this specific cost, and about cost of capital and the overall cost of capital, how to calculate. We did few sums and etc. etc. So this was our perspective, and of course I also talked about shareholder wealth maximization, because what is the real goal of the farm? So if you talk of the goal, why the farm? Why the farm? What is the goal of the farm? Financial goal, I'll rather say. So financial goal. So financial goal is basically, we have talked, it is SWMs, shareholders wealth maximization, and SWM is basically number of shares multiplied by current market price of the shares. So basically, this is your goal, and in doing so, what you must do is that you must raise your finance as cheap as possible. So, so point number one, raise your finance as cheap as possible. So this is basic, as cheap as possible. So this is basic, you got to raise money as cheap as possible. And number two is to invest at best, which is also the highest rates. So basically, what remains is R. This is the rate of return, and this should be greater than cost of capital. So this is the basic aspect of your financial management. This will only make you a growth farm. So, so unless until you do this, you are not a good growth farm. So this is the main objective of you, to be a growth farm. And very interestingly, this working note is that some books you will find stockholder, and in many books you will find shareholders. Now the stockholder perspective is an American perspective, but both means the same thing. So I could have just went on talking about this, when it happened, how it happened, but basically it is from the internet access, and you will find that both means the same thing. One is used in some country and the others are used in some other country. So stockholder and shareholder means the same thing, basically speaking. So and as I said, so this is the diagram which I favors. I love this diagram because the students who were there in the previous class also saw this diagram. This is the same. It's the balance sheet. So you raise money and you apply your money, and so you apply your money in long term and your short term things. The long term is called capital budgeting decisions and or investment appraisal, and the short term is working capital management. So you have your overall understanding and individual receivable management, cash management, etc. Individually you do this, and of course, so you raise your money. So basically there are three decisions to be considered, three specific decisions which make up the fat book of financial management. So you have your financing decision. So you raise money in financing decision, and you invest money, which is working capital as well as capital budgeting, and dividend decision, whereby you, and this is a goal of the firm. You need to increase the value of the firm. So we'll be talking about the value of the firm so very often today. And you remember that value of the firm is basically value of your equity plus value of your debt. So this is a term which you are going to use frequently today. And so minimize cost of capital and maximize your value of the firm. So this is every day when I start, maybe I will take 5 crucial minutes of your otherwise busy schedule to talk about this issue, because this is I feel the basic understanding of financial management. So you find this is from your study note, page 179 of the study note. So this is interesting. This is an interesting view of financial management. Investment decision, financing decision, and dividend decision, as I said. So investment decision is capital budgeting, working capital. So this is this. I started my course with your financing decision because I am the opinion that unless until you raise your money, you are unable to invest. So investment decision will come to me, at least that is how I perceive the situation. So I talked about capital structure the previous day. So today I'm going to talk about capital structure decision, and naturally the next day would be leverage. So this is where I am. This is where I am. And this is what I'm doing, basically speaking. So of the three decisions, I am talking about financing decisions, and financing decisions, I talked about cost of capital in the first class. Today, I'm going to talk about capital structure decisions, and maybe the next day, I'll be talking on leverage. So this is the whole issue, you know. So what we are doing, so my design is like that. I have to tell you some issues, and then you can read my document, because I always say that this is a 50-50 talk. Unless until you read the paper or you glance at the paper, you will never understand what the whole issue is about, because I'm spending 1 hour on the whole corporate structure understanding. So be specific to look into the perspectives. So you know what I am doing basically. So what I'm doing is I am talking about this side, and of course the current liabilities, or what you call short-term financing. This I'm not going to talk about, because this I'm going to talk about when I'm talking about working capital, because in working capital is actually current assets minus current liabilities. Of course, there is a number of issues to talk about this, but remember that in financial management, this current liabilities, which is a perspective of your liability side, is actually dealt under working capital management. So basically speaking, you are talking about this portion. This is what you call the long-term financing. Long-term financing. So if you, for example, if you take a bank overdraft, which is also financing, but that would be a current liability, and it would be basically dealt with under the head working capital management. So basically, we talk about 4 issues. That is equity, and your preferences, retained earning. So that is your basically reserve and surplus, and your preferences, and your debt. So debt would include long-term term loan. That means bank loans, long-term loans. So long-term is so it's a long-term loan. So that will include your long-term loans. So 1 equity, 2 retained earning, 3 debt, 3 preferences, 4 debt. Now the trouble is that we want to segregate this into 2 issues because of its nature: equity and debt. So we will this would help us in our understanding. So retained earning is okay. So equity is really it covers your retained earning. That is pretty sure. Regarding preference shares, most of the books, there are comprehensive studies how they are natured, but generally speaking, it is included in your preference shares. So this is of course just for you students, so you could easily have contradictory views on how preference shares behave, because there are different types of preferences, but conceptually speaking, preference shares are grouped under equity. So equity shares are grouped, of course, and of course you have your equity shares. So basically speaking, how they are defined is basically this is variable interest bearing security, and this is fixed interest bearing security. So this is fixed interest bearing security, and this is variable interest bearing security. So from that aspect, your preference shares are fixed interest bearing security, so they should be considered as it. But as I said, preference shares are a little dicey, but forget about these issues. For your initial understanding, we will always consider preference share as is everything okay? Okay, so this is the understanding I was talking about. Just a minute. A lot of noise, so I will just close the window. still not going. Okay, so hopefully things are okay. And as I said, so main perspective is our balance sheet is basically is a combination of equity and debt. This is how you this is the main perspective of your capital structure. So understanding wise how you are going to adjust your equity and debt, how you are going to how much would be, for example, you need to have 100 rupees. So how much would be debt and equity? For example, if there can be various financial plans. So financial plan 1, equity and debt. So in financial plan 1, sorry, ma, hello. So basically, in the one corner, this can be the situation. So for example, you need to have 100 rupees. So your financial plan 1 can be all. So this is basically a 100% equity financed farm. So this is basically a 100% equity financed farm. And on the other hand, absolute other hand, IDG, hello, just wait a minute, IDG. So on the other perspective, basically, sorry for the disturbance. On that perspective, you have a situation where your equity is 0 and your debt is 100. So these are the two. So these two are both ideal cases. This really cannot happen. These two cases really cannot happen. But these are the two ideal. So this is 0 equity farm. So this is a 0 equity farm. So there are various situations where you have various kinds of debt equity ratio. So basically the issue of debt equity, and we call this in various names. We call this leverage, we call this gear, and equity multiplier. So various names can be used for understanding this perspective. It's a very important perspective, and it is going to be there at the back of your books always. So how you raise your money? You raise your money fully from your equity, or you raise your money fully from your debt. So that is the perspective. And you can go both ways. So these are the two absolute situations. And now, why? How? Is this good? Is this situation good, or is this situation good? That is the main perspective. And as you have already know that, appropriate mix. So that is the main perspectives. What is the appropriate mix? And the appropriate mix is basically that will minimize my cost of capital. So my cost of capital would be minimized. So minimum K0. And the moment you minimize your K0, you got to understand that your V0 is maximum. So the moment you minimize your K0, your V0 is maximized, which is also represented in the earnings per share, also represented in earnings per share. So your earnings per share is basically, what is the concept? Because earning per share is basically, earnings after tax minus preference dividend, which we separate out, because they are you pay the same amount divided by number of shares. So this is your earning per share. And if you remember that V0 was basically number of shares into your EPS, P0, into your EPS, number of shares into now into P0. So this is your P0 will increase if your EPS increases. They are directly related to each other. So basically speaking, your market price of the shares would increase if your EPS increases, and if your EPS is calculated as earnings after tax minus preference divided by number of shares. So the main target is to minimize cost of capital, and when you minimize cost of capital, it will increase your EPS. That is what I'm going to show you throughout the remaining half hour, 45 minutes. And the moment you minimize your K0, you maximize. So, the point is a very important understanding. Then we have some definitions. Forget about the definitions. So another important issue is that in some books you will find the term financial structure, and in some books you will find the term capital structure. But I would rather use the term capital structure, because financial structure would include your current liabilities or short-term loans. So as I was saying, that what we are going to do is that we are going to change. The issue is we are going to change the debt equity ratio. We are going to change the debt equity ratio and see whether value of firm increases or decreases or remain constant. So this is the main perspective. We are going to change. We're going to change the DE, debt equity ratio, and we're going to change the debt equity ratio and see whether the value of the firm remains same or whether it diminishes. There's no question of diminishing. Might be. I don't know. I'm not sure about it. That is why the capital structure theories are so very important. So this is a scenario, and so I have included 3 definitions and factors determining. So you can easily refer to this. Leverage. So as I said, this is basically your debt equity ratio, and you can also call it trading on equity. Trading on equity. So this is a very interesting term which will be coming up subsequently, but this is the same issue. We also call it equity multiplier. Equity multiplier. So we call it equity multiplier, and we call it very many names. Gearing. We call it gearing. Gearing. So we call leverage. Actually, this is not leverage. This should be financial leverage. This should be financial leverage. So this is actually financial leverage. So this is we call it debt equity ratio. We call it trading on equity. We call it equity multiplier. We call it gearing and various things. So these are the there are 3-4 definitions. So there are definitions of capital structure. What capital structure really mean, and you have to understand that capital structure is different. So capital structure is different from financial structure. So there is, I have, if you look at this is what I'm talking about. Be specific about this perspective, and so you have your definition. I have given 3 important definitions. Not me; these are from various books I have collected from your study notes as well. And these are the factors determining the leverage, the capital structure. So leverage, capital structure, nature of business, size of the company, legal requirements. So you got to, different perspectives are there. So you can just, these are all reading issues. So you can easily read government policies. So these are all now the fundamentals I have told you. So basically speaking, there are 2 issues, equity, and we have to group them. We have to really group these 4 aspects into 2 terms. So 4 aspects are equity shares, once more, equity shares, and you have your retained earnings. So that is pretty easy. So they are together. And preference shares is what we do. We don't know. There have been a lot of studies, and there is of course debt, which includes term loans. So preference shares in most cases would go with them. So basically you have 1 and basically you have 2. So you have to group these 4 issues into 2 main issues, that is your equity and your debt. So this is gearing, which we'll be using in our specific terms. which talks about your financial risk. In leverage, I will talk about the risk perspective, the business risk on the. So, I have told about this. So this is a high geared firm. That means your debt percentage is high. Debt is high. So, debt percent is this much and equity percent is this much. So this is a highly geared firm where you have this fellow runs on huge amount of loans. So there are very people who doesn't mind getting loans and runs through loans or equity or EMIs. For example, just a feeling, I have never been to America, but I'm told that they have huge amount of UMIs, or they run a huge amount of dates in their structure. And the other is a low geared firm. So there is a reason why this is called low geared and high geared. Very simple, gear as in your car. So if you are highly geared, if you are into your fourth gear or fifth gear, you will run very fast, but it will also be a risky situation. So if you have more debt in your capital structure, you will run very fast. So it might look that you have so much in your house. You might be having 2 or 4 houses, but and more gadgets and this and that, but you'll be more risk prone. So you'll be prone to risk. But if you are low geared, so that means you have very less debt in your capital structure. You are moving in fast gear. That means you are very strong. So your car doesn't get stopped. So you are very strong, and it might not run very fast, but it is very strong. So when you are rising up the slope, you will be low geared. You will never. So basically speaking, it is about risk. So do you want to take more risk? If you take more risk, that will also be more return. So this is not the idea of the thing, but if your debt equity ratio is higher, that means you have assumed more risk. And the moment you take more risk, you will generate more return. So this is a basic phenomenon. You generated more return. So this is a basic phenomenon, and this is the crux of the whole perspective, that our capital structure can be highly geared, and if it is highly geared, we will have more debt in the capital structure, and the more debt in the capital structure would mean that the return is higher. So the Ebi Et remains constant. So it remains. I have some sums to show you. Let me. So there are basically 4 capital structure theories. So NOI approach, NI approach, traditional approach, approach. And the perspective is, I will tell you, in search. So why this? In search of optimal capital structure. So basically, we are trying to get into a very good capital structure, and that is why. So there are some assumptions. Forget about it. The main perspective is no taxes and 100% payout, and etc. etc. So you can just refer to the book. There are perspective. These assumptions are very meaningful. And it's a perfect capital structure, capital market. So everybody can raise without information asymmetry. And these are the 4 structures. Very interestingly, you can. There are 2 structures which says yes, if your capital structure. So I'll tell you this. Please refer to this. This is a nicely structured. So capital structure impacts the value of the firm. Yes. Who says? NI approach and traditional approach. These 2 approaches says yes, capital structure impacts the value of the firm. Capital structure does not impact the value of the firm. Who says? NOI approach and Modigliani-Miner approach. So these are the 2 issues. Wood says these are the 2 models. So these are the 4 models, all in search of that one ultimate optimum capital structure. So after every model, we will try to identify whether there is an optimum capital structure or not. So in one perspective, you have your NI approach. So you call this NI approach. and this is called NOI approach. So very advanced books doesn't really talk about this, but I feel this is very important because this really lays the ground for your traditional approach and your modular linear approach. So modular linear approach is basically an explanation to the NOI approach. So let us go. So how things are designed. So these are the basic formulas which you are going to require for solving of the sums. So I have 4 sums for each of them, and a graph to explain. So KD is this annual interest charges by market value of the firm. KE is and earnings available. So EAT, earnings after tax by market value of the equity. And K0, very interestingly, K0 in these perspectives. So very interestingly, we just listen to what I'm saying. You have had a very understanding of about your K0. So in our previous class, what you have done, it is KD into weight of debt in the capital structure plus KE into weight of equity in the capital structure. So this is the thing which we did in our capital structure. So, but here, at least for the first 3 perspectives, K0 is Ebi Et by V. V is the value of the fund. So it is basically the capitalization rate. So WACC, or working capital, weighted average cost of capital, is a capitalization rate. And as I have pointed out, your value of the firm is your value of the debt plus the value of the equity. And the issue is what happens to your KD, KE, K0 as the degree of leverage changes. So this is the main perspective. You know, we used to call it debt equity, but now it's the same thing. We call it a B by S ratio. Why B by S? Because I have said that value of the firm is B plus S. So basically this. So for example, if the value of the firm is 100, it can be 20 plus 80. Or it can be 80 plus 20. It can be 50 and 50. So you just can go on talking. So this can also be 100 and 0. All debt fund. It can be 0 and 100. So now this is the basic aspect. If this changes, if we change this, if this rises, if this changes, means your B portion changes. That means it becomes more debt prone. So it becomes debt prone. So as it becomes more debt prone, what happens to your value of the firm? So what happens to V0? That is our main perspective, what we are looking to. So the first 2 approach are both by David Duran, and so now the main perspective, I'll show you the sum as well, because I had the sums, but I don't think there is time to solve the sum for you, because I left some space for solving the sums for you. So this is must. You must understand this. You know, always your KD is always less than your KE. So your KD is always less than your KD. That means cost of debt is always less than your cost of equity. But if this is a situation, then you should always increase your, so you know, look, cost of equity is 10% and cost of debt is your 5%. So if this is a situation, so who says this? This is NI approach. So your NI approach says that as you increase your leverage, so as you increase your B by S ratio, your K0 starts to fall. So basically speaking, your optimum capital structure, your optimal capital structure is basically hypothetical at the farthest right, of the curve. Of the right. Now, you know, look, it is growing down, and the more as K0 goes down, your V0 increases. So you got to understand this. Have to be sure. You got to be very sure about this. as your K0 down, because V0 is a capitalization. Basically, this is what you do. So V0 and K0 are so this you capitalize your EBIT with respect to K0. You know, so if you look, I have this. So look, if the K0 is EBIT by V, or the vice versa, V is equal to EBIT by K0, same thing. So you know, so this is a model which says that your K0 basically goes down as you increase your B by S ratio. I have a sum. I had the intention of solving the sum, but it is only. Let me solve the sum right in the beginning, and maybe I'll check out. So you know, I might be taking 10 minutes, 15 minutes extra. So please bear with the situation. So please bear with the situation if I take 10 minutes extra. Okay. I'll come back and check out your questions. So you know so this is a illustration. So I have 4 illustrations. Each illustrations with the model. So NOI model. So the farm has 6,000 in date. So you have date 6,000, and sorry, your date is 6,000. Fine, and these are 5% debt. So you pay 300 rupees, basically speaking, for the year. So your EBIT is EBIT, earnings before interest, tax and taxes, is 2,000, and cost of equity or KE is 10%. And this is the main perspective of NI approach. Your KE and KD are constant. So if you look at the curve, you will find that this and this are constant. So they are straight lines. That means these two are constant. So basically what we do, I'll run through the sorry, I don't think there's time to solve this question. So these are already solved. So what we do is that we first of all calculate EBIT, this is earning after tax. So your earning EAT is earnings after tax. So your EAT you calculate, because you are going to earning I is for your debt holder. So you separate that. And your value of the firm, as I said, is S plus B. That is equity, value of equity plus value of debt. So S is basically EAT by K if you refer to the formulas which I have shown. Just for your understanding, V or V0, V is EBIT by K0, and KE is the S is earnings after tax. So you just remove EAT is EBIT minus earning interest. So you just remove the interest factors by KE. So that is the formula we have used here, earnings after tax plus B. B is given. So B here is given in the first perspective. It is 6,000, and then we'll show you how it changes. So you calculate your V. V comes to this, and your K0 is EBIT by V. It comes to this, and B by S ratio is 35.29%. So 6,000 by just very easy to understand. And when your date, so a date goes down from 6,000 to 10,000. That means the B by S ratio changes from, it was previously 6,000 by it was by 6,000 by 17,000. So equity was, so it is basically date by equity. So date by equity is this changes to this changes to 15,000. So this changes to 10,000 by 25,000. So this changes, you know, this ratio changes, and the total impact is shown in this nice diagram, which is absolutely, which I drew up. If B by S ratio changes, you see the main perspective is what about your K0. So as your B by S, so as your B by S increases, your K0 decreases. That means it implies that value of the firm shall increase. Value of the firm shall increase. So this is the main perspective what happens to this situation. So NOI approach is also by David Durand. And what happens again? He says no relevance. That means as you increase your B by S ratio, your K0 remains constant, and therefore your V0 remains constant. So this is the main perspective of the point, and what he says is that K0 remains constant, and the argument is very simple, provided by NOI approach, is that the increase in KE is absolutely offset by the lower cost of debt. So basically, the perspective, the point, the only explanation that is provided by the professor is that the higher cost of equity is absolutely offset by lower cost of debt. So this is the only explanation which the professor suggests, and this explanation is furthered. So basically, in Modigliani Miller, what happens? The explanation is furthered. It is much better given the explanation. So that is why I would spend more time. So this is a NOI approach, and again the perspective I have taken a sun, and here very interestingly, K0 is constant at 10%. So now you find that K0 is constant at 10%, and again I have solved the sum for you. I thought of solving the sum in the class, but I couldn't. And you just go through the sum, and this is the net result which you will be having. So you look. As your B by S or leverage increases from 42.6%, 86% to 100%, your K0 remains constant at 10%. And the moment it does that, V, which is nothing by Ebi Et by K0, is Ebi Et is same. 2000, and K0 is 10%, so naturally the value of the firm would be 20,000 irrespective of the situation. So just let me check out. Look, the value of the firm when B by S is 100%, when B by S is 100% is 20,000. And what about this situation? It is same at 20,000 when the B by S ratio is 42.86%. So this says that irrespective of whether what the value of the firm, what the value of the B by S ratio is, your value of the firm remains the same. So now we have the traditional approach, and I'll just take so if anybody any of the organizer are here, it is I think it would be okay if I take if I take few minutes extra. Please excuse me if I'm unable to finish, because it's impossible. So now the traditional approach is basically a combination of these two. It's a combination of these two approaches. So it's basically it's a combination of approach, and very interestingly, this is only place where you do have optimum capital structure. I'll show you. So you do have an optimal optimum capital structure. How? Now, what it says is that very interestingly, this says that there are three situations. I'll directly go to the. So there are primarily as such no assumptions as in NOI approach, we assume K0 is constant, and in NI approach, we assume that the KE and KD are constant, has to be constant otherwise. So those two approaches in very advanced book, you will find very less discussions about the previous two approaches. They will start with traditional approach and they will proceed to more degrading. So let us come to this diagram and let me talk about this. So what happens to the, so these are the cost of capital. So these are basically, so this is basically your KE and this is basically your KD, which they call KI. Forget about this. This is from where I started. And this is your K0. So you also have your K0, which is basically your the balance of all these issues. So what happens when your B by S increases? So this is an increase of B by S ratio. And what happens to the situation? So basically you have three particular stages for that matter. What happens? In the first stage, both KE and KD are constant. So just think of a person in your arena who runs on who is just a person. So you don't know him and you are ready to loan him money at 5% or 10%, fine. But the moment you know that he is highly levered, that he is running on huge loans, you will also raise your expectations. So at the third stage, so this is the third stage, KE also starts increasing. So this is the third stage. So this is the first stage when both are constant, and therefore since KD is less than, so this is a stage 1 where KD is less KE is greater than KE, and the more KD you have, up to this, your KE will start diminishing. Fine, but at some perspective, it will have a, it will not change much. Mainly because the proportion is changing, and this is I don't think this diagram is very representative, because this stage would not be a very long stage, and after that K starts increasing and risk perception also start increasing. So risk perception start increasing, and therefore your K increases, KD also increases, because both the farm's risk profile has changed. The risk profile of the farm has changed and it has become more risky. So the debt, bank and individuals, everybody knows that spending more on this farm would mean that it is a risky farm, and therefore your average cost of capital starts increasing. So there are three stages to this model. It's a nice stage, and be careful about your model. And in my small analysis, I have taken the assumptions and the three stages. If you look, stage 1, stage 2, and stage 3, the three assumptions and the major issues. So these are the major issues. You can just read through this, and there is a optimum capital structure. And so the cost of equity rises. That the third stage, the cost of equity rise will have a detrimental effect to the WSEC. That means I'm talking about the third stage. So the risk profile has changed, has increased, and since the risk profile has increased, so your WSEC will start increasing at a rapid rate. So this is the traditional approach, and again I had a sum and which I thought of solving for you, but naturally, thank God that I created this. I solved this sum yesterday night, so this should be for you. And Ebi Et is there, so same thing, that the procedure is similar. The process is same. Only point is that there is no assumption that KD. So the first was that in NI approach, basically you assumed your KE and KD to be constant. In NOI approach, you assumed your K0 to be constant, but here you don't do that. You're doing that at the same issues. So the same issue we calculate, and again your this rises from 10. So your B by S increases from 42.35% to 100%. Most probably this is 100%, you know, because it is 6,000 by 14,000 in the first case, 14,167, and 14,167. So this is the first case, and second case is 10,000 by 10,000. Most probably. Let me check out. Look, your S is look. This is the perspective. You know, you have raised equity 10,000 and your debt 10,000. So 10,000 by 10,000. So this is 42.35%. This is 42.35%, and this is 100%. So this is your 100%. Naturally, your B by S ratio changes. What will happen? Look, as your B by S changes, so as your B by S increases, your K0 falls from 9.9% to 10%. That means, sorry, K0 increases. K0 increases. That is this is the third stage. K0 increases. Sorry, B by S increases. I think I have made an error. Let me check out. 9.9%, 10%. So it's minor, you know. I think I have to check out. So I'll surely give you a rectified copy. I think I have made an error, and will surely give a rectified copy. So the perspective. So actually, you cannot define it. I don't think it is an error. Actually, there will be three stages. There will be three stages: stage 1, and stage 2, and stage 3. So there will be three stages, and basically speaking, as your B by S changes, your K0 should increase in the third stage. So this is basically a sum on the third stage. Look, as your B0, yes, your K0 increases. So this is basically a sum. So as your B by S changes, so this is a sum on the third stage, stage 3. So basically, when your debt increases from 6,000 to 10,000, your K0 also increases. So this is basically your K0 also increased. That means this is a sum on the third stage. This is sum on the third stage. So maybe if the increase was not this significant, that means 42.35% to 100%. Maybe if it was 62%, 6%. So if you can in your house, you can really make three stages, 42% to maybe 60%, maybe to. So if you can change this date percentage, I think you will also have the. So basically, our understanding is of the third stage, stage 3. Now I have. So this is basically third stage. I think this much is sufficient. This is a third stage situation to 100%. So this is a huge increase, and therefore this is a third stage sum. This is third stage situation. Now we finally come to Modiglieri-Miller. Though it is 1 hour, I think let me finish this, and then I will take questions. And you know what he did was very simple. Here also there are basically two models: one without taxes and another with taxes. So we are only doing with taxes. So what he did was that he just gave a very good explanation to the NOI approach. So basically, this is a very good explanation. This is basically a very good explanation to NOI approach. So this is a very good explanation to the NOI approach, and the explanation is arbitrage. So I would have loved if I had got some time to discuss about this, because I had some also. Now, what he says is that basically, just listen to me and forget about. You can read this document. What he says is that there are two companies, 1B. Everything is same. Everything is same for the companies. Only one is geared. This is geared. That means it has some date in capital structure. This is ungeared. That means no date in the capital structure. So what he says, his proposition 1 is simply this, that geared value of a geared firm is value of the ungeared firm. So this is his proposition 1. Why? Because you just average cost of capital, as you know, is basically the capitalization rate of a purely equity stream of its class. So basically, these two are two instruments which you buy, and one, for example, these are two companies. Maybe I'll just name SSC Cements and HDFC Company. One doesn't have date in its capital structure, so it is ungeared. So let us assume that HDFC is ungeared, just in the absolute, and SSC Cement is geared. That means it has some date in its capital structure. So the value of the firm. So you would not differentiate between these two companies. That is what Modigliani said. Modigliani and Miller said in his proposition 1. So he said in his proposition 1 that basically the value of a geared firm, that is SSC Cement, who has date in its capital structure, will not be different from HDFC, which is ungeared, that is a 100% equity firm. So this is basically a 100% equity firm, 100% equity. So a 100% equity firm, so this is a 100% equity firm, and therefore the value would be same as SSC Cement. This is what he said basically. Now in 2, this is what he says. The cost of equity of a geared firm. What he says, this is basically the risk premium. So this is basically the risk premium. Now just think that you are putting your money in SSC Cement, which is geared, which has debt in its capital structure. How you are going to calculate that? Basically speaking, the cost of equity of the ungeared firm plus the B by the debt equity ratio multiplied by the excess of cost of debt, because which cost of debt is it doesn't depend on the debt is available at 5%. So debt doesn't depend on the company being geared or ungeared. So minus ungeared firm. So basically speaking, this is what his proposition 2 boils down to. It would have been wonderful if I had got time, if I had got your understanding, if you had said, sir, this please talk about this a little bit more. But unfortunately, this cannot be done. What can be done is that you go through my documents, join my classroom, go through my documents, and ping me through the classroom, and I will surely try to answer your questions. Maybe even in my next class, I will answer your question. And the third is basically this: the WACC of the geared firm is the WACC of the ungeared firm. That means these are what is WACC? It is your capitalization rate. So naturally, the value of your HDFC and the value of would be equal to value of your SSC Cement. And SSC has date in its capital structure, and it is a 100% equity firm. So this is what the perspective is, and if the two working capitals are weighted average cost of capitals are equal, the value would have to be equal. And these are the three propositions. You go through this, and this is from your study note. They have simplified the matter. So please look into this. And I had this. This is also I thought of solving this for you. Okay, I had this is what I did. I solved this in my hand for you. Thank God I have solved this in my hand for you. So actually, this is a simple case where X PLC is public limited company. It's from a foreign authored book. So X is in all is identical. Is the same. It's the same in all operating and risk characteristics to Y PLC, except X is all equity finance and Y is financed as 2.1 million of debt and equity of 2.1 million. So this is equity and this is debt. And these are at market values. So the only difference between farm X and farm Y, this X is a 100% equity finance farm, and Y is has debt sum in the structure, and how it is 2.1 million equity and 0.9 million of debt. So the interest paid is given. Of course, X will not pay interest. Y will pay interest. Interest paid is given, and the dividend payment is given. And X pays an annual dividend of 4,50,000, and Y pays 3,78,000. So look, Y pays 72,000 as interest and 3,78,000 as dividend. So, and this he pays 4,50,000 as interest, as a dividend. So look, both are paying 4,50,000, because both the farms are similar in all respect except for the debt equity ratio. Both the farms are same except for the debt equity ratio. So this is a synopsis of the two farms, and identify the value of X. So you are going to find the value of X which is ungeared. The value of X which is ungeared. You know this, the KE of ungeared farm is a KE of the geared farm. So value of X, value of ungeared farm is the value of ungeared farm is equal to the value of geared farm. So you calculate the value of ungeared farm. Geared farm. That is 3 million. So Y is geared farm. It has debt in its structure. So you calculate that. And cost of capital for X PLC is the KE of ungeared farm is 15%, and therefore that is also the same for the debt farm. And the cost of equity for Y is 18%. And very interestingly, actually this is wrong. This is this should not. This is wrong. This is wrong. K0 is same. K0 is same. So basically K0 of geared farm is equal to K0 of ungeared farm. Because if this cannot be same, because otherwise I say, nah, I give you the formula of the KE of the geared farm and the proposition 2. Look, this is the KE of the geared farm is equal to KE of ungeared farm plus a risk premium, because one company has both debt in the capital structure, so naturally it is to be different. So naturally this is wrong, and you calculate using the formula which I have given you, KE of the geared farm, but this is the risk premium. This is the risk premium because you are putting your money in a farm which has debt in the capital structure. So naturally, it is so the geared firm cost of equity is 18%, whereas the ungeared firm it is 15%. And look, the final. So as I have said, the K0 of the geared firm, which is 18%. We will find out. The K0 of ungeared firm. This is it. This we find out. So this we find out. Now here is the point. Here we use our usual understanding. Our usual understanding, weight multiplied by date, weight multiplied by. So this is interestingly different, and that is why Modiglieri-Miller is an interesting idea, because over there we used to, in previous situation it was Ebi Et by V, K0 was Ebi Et by V, but that is not quite what I said in my previous lecture about working capital or cost of capital. So now we use our usual understanding of cost of equity, or cost of overall cost of capital, and look, it is 15%. 8% into 9 by the proportion of debt. 8% is the cost of debt into proportion of debt. 18% cost of equity into proportion of equity, and it is 15%, which is also the cost of equity of the which is the cost of capital of the ungeared firm. So this is cost of capital of the geared firm. We calculate the cost of capital of the geared firm, and the cost of capital of the ungeared firm, which we calculated previously. Let us check out. Look, we calculated the cost of fund of the ungeared firm, and that was 15% as usual. So this is 15% in the usual. That means our hypothesis is okay. Now, why of IMM? Actually, here also I just wanted to tell you just a basic issue. You know? So X and Y are two companies. This is 100% equity, and this is geared. That means has debt in capital structure. So this is X is a company. Now you just think of yourself. Maybe me, JD. What I am thinking? I'm thinking of buying securities. I'm thinking of buying securities. So this is the X firm, and this is Y. This is 100% equity. This is therefore ungeared. So I'm thinking of buying a security X or security Y, maybe debt, whatever, because X doesn't have equity, most probably equity shares. So the moment I think of buying, if I am very risk averse, I will buy X. Now, if I want to buy Y, I will be buying into a geared option. That means I'm also going to buy in the debt structure. Now this is a levered firm. Levered firm. This is levered firm. This is unlevered. So if you want to move from this to this, what you generally do is simply that you get into your you basically get into your personal leverage. So basically, if you are trying to go from here to here, you just make your adjustments into your personal. That is the whole issue of arbitrage. Arbitrage principle is basically a principle which is very important in finance. Basically, it is actually in the finance world, no option should exist where you can make profit without taking any risk, without taking any, getting into any cost. So that opportunity shouldn't exist in a well-efficient, perfect market. If it exists, people will come and take advantage of it, and therefore identical equilibrium prices would be distorted. So naturally, arbitrage principles suggest that in an equilibrium market, that kind of price cannot exist. It has to be done away with. So in an equilibrium market, there cannot be an opportunity to make profit without undertaking any cost. So here also, if this value was higher, if this value was higher than this value. So if, for example, if value of y was higher than value of x, we can actually they showed that arbitrage opportunity exists and people will move from security X, they will sell security X and buy security Y, even if that requires going away some of their personal leverage, homemade leverage. Or if, so they will show, or if value of X is less than value of Y, same thing can be shown actually in their, I just tried to look into their famous papers and the various documents available. For example, even in Prasanna Chandra's book, huge understanding is available as regards to this arbitrage procedure, how it operates. But basically speaking, if these are the two situations which are available, it will not hold good. It will lead to arbitrage, and therefore people will move, will sell off their securities X and will buy security Y, or will buy move from security X Y to buy security X. So if these two are false, then what remains is that value of X is equal to value of Y. So basically what Modigliani-Miller suggests is that there cannot be an arbitrage opportunity in a perfect market, which is a basic understanding of your finance. And he says that if a levered firm could increase its value just by getting more debt in the capital structure, then he will always go on doing it. And if he always goes on doing it, there would be arbitrage opportunity for JD, an investor. And if he can invest in such a way that he will shift from X to Y or Y to X, then there cannot be an equilibrium price. So basically what Modigliani-Miller does is that they propose a very good explanation why the two values would be equal, and if the two values are equal, then weighted average cost of capital of X is equal to weighted average cost of Y, which is an unlevered firm. So that would be all for today, and now I will check on to. So the point is that dismiss. Good morning. I don't know about WhatsApp group because this is absolutely institute material. Even good morning. WhatsApp group. I don't know. So is any group created for CMA interest? No, I don't know any phone group created, but at least there is one of my private one of my classrooms through which I share my notes which I have done, included my workings. So that if you join my classroom immediately after that is absolutely your option. You can join my classroom and immediately you get the material which I have talked about. Okay, fine. Then I don't know about phone numbers. Lots of noise in the background. Sorry, very sorry. There was some cleaning going on, sanitizing going on. I'm very sorry for this. I know, Karthik, I know there is a gap between 25th March and today, because that is absolutely an institute material. So whenever they asked me to do a job 5 days back, they asked me to do the job, and I prepared the material and I serve you. Can you explain regarding what? I'm not sure. Can you suggest good book for P10? Okay, Anonymous, good book for P10. First of all, your many of the questions you need to have, you cannot ignore your study note. The study note is basically a very good guiding aspect which you should always refer to. You should keep in your beside you. And there are a number of books I love regarding. Actually, there are two separate aspects. So you cannot have one book for both cost and management accounting and financial management. For financial management, I think I love, at least my perspective, I love Prasanna Chandra, and I love Prasanna Chandra is a little bit difficult situation, but this I Am Pandey. It's a beautiful book. Please, I Am Pandey is a very good book. I Am Pandey is a very good book. I don't know whether you already have or not. And Prasanna Chandra. So these are the two books. Please, Prasanna Chandra. So these are referred teachers, and I love them book. They are both maybe from the institute. I don't know about the WhatsApp group. I am not very sure, but I do have a online classroom, so you can join the classroom and immediately get the material. Also, you can ping me with your queries. So it might, because there are so many attendees, and if everybody pings me regarding their queries, I might take a little bit of extra time, but surely I will come up with the answers. Not very sure. Pune chapter, I'm not very sure about oral coaching. Thank you, my pleasure. Good morning. How can a regular update for all institute lectures? That regarding that, you contact with them. They can give you perspectives. But what I generally do is that whenever I get an when I get an invitation to talk, I publish that in my classroom. So if you join my classroom, I always give a, I'm taking paper 8 and paper 10. Maybe I would take some other lectures. I don't know about that, but the moment I get invitations, I publish in my classroom when my lectures would be. Shiny Nayak. Oh my God. Okay, Shiny, thank you for being, you are also a colleague of mine. Nice to have you out here, and wonderful to have you, Shiny. Well, of course, I Am Pandey is, I feel it's a very good book, and Prasanna Chandra is wonderful. But regarding you, since it is an honor to have you out here, Shiny. You have been a very good friend of mine as well. Well, Shiny, you can refer to Brearley and Myers and Stephen Ross. So Brearley and Myers is a beautiful book. I love that. Brearley and Myers, M-Y-E-R-S. So Brearley and Myers, I love Brearley and Myers. I love Stephen Ross. So these are, you can get these books in the internet. And of course, there are some other books also. Thank you, Shiny, for being there with me. I don't know how to go about studies. You can guide us. Of course, please specify your questions. Now, one thing I would surely talk about is that you cannot take these courses as such. You know, this is a big mistake students do. When you are studying for paper 8, you have to think of paper 10, 14, and 15 together. So paper 8 comes with paper 14, 10, and 14, and 15. So these are a chain of things, you know, and that is one big trouble which students does. So I would request you, when you are studying paper 8, be conceptual, even if it takes more time, and don't just solve sums. So if you have done my classes, you will see that I don't only solve sums. I also really talk about the understanding. So for example, if you are creating your understanding, I'm talking to yes. So if you are creating your understanding about, for example, standard costing, you got to remember that you're going to use it in paper 10 and you are going to use it in paper 15 as well. So you cannot take each of them individually and study like that. So you got to have a strategic view of it. You know, in paper now in financial management, oh, 50 marks hai, koi baat nahi. So you just do it and get to the examination. No, not that. You got to study for, you know, you got to do strategic financial management in paper 15, and therefore, you know, you got to get into that as well. So that is why your conceptual understanding, you just look at paper 10 and see, no, capital structure is not coming in the examination, so let us not do it. But that is not right thing. right thing is to study that conceptually, and once you do it conceptually, it will come to good effect. For example, marginal and relevant costing. So in paper 8 you study that, and in very later terms in paper 10 and in paper 15 all this is going to come to use. So that is, I think, the initially a good book for paper 10. As I have told you, I am Pandey, and yes, for financial management, I am Pandey is a good book. Cost and financial management is a good book. Thank you, Shani. Thank you. Add. Thank you, sir. Concepts are very clear to know. Thank you. Thank you very much. Okay. Thank you. Thank you, sir. Thank you. Yes, absolutely, Ashwini. Anybody who really joins my classroom will have the study note immediately after the class is over. So after the class is over, you can have my class notes. And just once more, I will give you the link. So this is the link, and many of the students are already a member of my classroom. So basically, it goes to the institute, and then the institute decides on it. But generally, what students can do is that they can enroll in the classroom. Absolutely. And after the class, I hand over a PDF document with my notes. With all my notes, I get into the PDF document and I submit in the classroom. So I have already taken 26 minutes extra of your class. So anybody who wish to ask any more questions, you are most welcome. I got the last question at 12:25. But remember, the moment I am giving another chance to talk about, I will be talking on leverage. So that would complete the financing portion. The financing issues would be completed, and then I will move on to the investment portion or working capital management as such. So if it is done, thank you for being with me, and it has been an honor that one of my colleagues is out here also teaching, learning about the issues. It's really a challenge as well. So I'll keep in mind that Shani is here. Thank you, everybody. And if it's okay, I will end this session. Thank you very much. So thank you for being there at the back of my laptop. So I don't know anybody is there, but I know that you are, of course, here beside my laptop. So that is all. Thank you very much. Meet you when I am again invited. But remember that whenever I am invited, I will ping you through my classroom. Thank you very much.